So, you've probably heard about T-bills, T-notes, and T-bonds. But what are they really? They can sound kind of complex, right? Well, they're a huge part of the financial world, and in this explainer, we're going to break it all down. We'll make it super simple, I promise.
I love this quote because it just cuts through all the noise. Forget all the complicated jargon for a second. Think of it this way. You are literally acting as a bank for the US government. You're lending them money so they can, build roads, fund research, all that stuff. And just like any loan, they promise to pay you back plus a little extra for your trouble. It's that simple at its core.
All right, here's how we're going to tackle this. First, we'll talk about what it means to lend to Uncle Sam. Then, we'll meet the Treasury trio. After that, the important part, how you get paid. We'll cover some need-to-knows for investors and then wrap it all up with the final takeaway.
Okay, let's jump into that first big idea, lending to Uncle Sam. When you buy one of these securities, you're essentially making one of the safest loans in the entire world. I mean, it's backed by the full faith and credit of the US government, right? But there are a few different ways to do it, and the biggest difference, well, it all boils down to one single idea.
And that one idea is maturity. All maturity means is the length of the loan. How long are you comfortable letting the government borrow your money before you get it all back? Is it for a few weeks, a few years, or maybe even a few decades? This one thing, maturity, is the main way we tell these different securities apart.
So, with that key concept of maturity in our back pocket, let's meet the Treasury trio. You can think of them as three different flavors of the same basic investment, each one built for a totally different timeline.
This table lays it all out perfectly. You've got your T-bills on the short end, we're talking a year or less. Then there are T-notes, which are kind of the medium-term option, anywhere from 2 to 10 years. And for the long haul, you have T-bonds, stretching way out to 20 or even 30 years. And you can see right here how the way you get paid, and even the risk level, changes with that timeline. It makes sense, right? The shorter the loan, generally, the safer it is.
Okay, so they have different timelines. Got it. But how do you actually get paid? That's what we all want to know, right? Well, even though they're all government debt, there are actually two totally different ways you make money from them.
Let's start with T-bills. They use what's called a discount model, and it's actually pretty clever and super simple. You buy the T-bill for less than its face value. So, for example, you might pay, say, $970 for a bill that's actually worth $1,000. Then you just wait. When it matures, the government pays you the full $1,000. That difference, in this case, $30, that's your entire profit. No interest checks, no complications.
Now, T-notes and T-bonds, they're different. They work more like a loan you'd recognize. You pay the full price up front. Then, every 6 months, like clockwork, you get an interest payment. You might hear this called a coupon payment, which is a cool little throwback to when bonds were physical paper and you'd literally clip a coupon off to get your interest. Then, at the very end of the term, whether it's 2 years or 30, you get your original investment back.
Okay, we've got the basics down. We know the players, we know how they pay you. Now let's get into some of the need-to-knows. This is the stuff that can really make a difference for an investor. All right, 3 really important things here. First, yield versus price. Just think of a seesaw. When one goes up, the other has to go down. It's an inverse relationship. So if your bond pays 2% interest, but new bonds start coming out that pay 3%, well, your 2% bond isn't as hot anymore, so its price on the open market will drop. Make sense? Right? Second, liquidity. This is huge. You are not stuck with these things until they mature. There's a massive secondary market where you can sell them pretty much anytime you want. And third, this is a really nice bonus, the interest you earn, it's exempt from state and local taxes.
Now, hold on. A quick clarification on that tax thing. You get a break from your state and local taxes, which is great. But Uncle Sam always gets his cut. The interest is still taxable at the federal level, so don't forget that.
So, we've covered a lot. What's the big takeaway here? What does this all mean for you in the real world? Let's boil it all down.
And here's the pro tip for you. When the stock market starts getting all volatile and crazy and people get nervous, you'll see a ton of investors run to T-bills. Why? Well, they're super safe, and because they mature so fast, your money isn't locked away for ages. For all intents and purposes, they're almost as good as cash. That's why they're called a safe haven.
So there you have it, the short-term, medium-term, and long-term ways to lend to the government. We've gone over how you get paid, the key things to keep in mind. So now the real question is for you. Looking at these options, which one fits your timeline?